next speaker, and that is Graham Banks. Graham joined Morrison Financial in 2009 and has over 35 years experience in structured finance and private lending, with a primary focus on lending for construction projects in Ontario. Graham oversees the Condo Corp Term Financing Program, one that provides term debt to Condo Corps across Canada to fund major repairs, replacements, additions, and alterations to the common elements. Graham is a member of the CFA Society Toronto, where he spent 4 years as a volunteer in their mentorship program, and is a past director on the board of Build GTA. He holds a Bachelor of Commerce degree from McGill and is a chartered financial analyst. So Graham's going to be discussing various types of financing for Condo Corps, and I'll turn it over to Graham now.
Thank you, Josh, and welcome everybody. Thank you for coming to the presentation. My first slide. Can you advance this for me, please? So the first thing to talk about is the self-financing concepts. It's the primary discussion in this forum. What we're talking about typically is creating significant improvements to the common elements. And the question is, the first question to answer is there substantial savings that can offset the costs? And if there are substantial savings that can offset the costs, then you can look at self-financing concept. And that could be in the form of energy as a service program, or it could be in the form of a loan, which would simply conceptually, the savings would offset the debt service. So it is a bit of a different decision from the decision as to whether it's viable to implement the improvement. It is a financing decision. So what are the sources of capital for condominiums energy retrofit? The special assessment is the first go-to, I think. When you buy something, when you need something, you buy it, you write a check, and you buy the thing and you implement it, and it's the easiest way and arguably the best way. In the environment of a condominium, though, one has to consider your neighbors, people's affordability, and in spite of the fact that there's a strong argument in favor of implementing the measure, there is oftentimes not a universal affordability among your neighbors. So the special assessment, while it's a great idea, in practice, it is extremely unpopular. The second place you might go is the reserve fund. And I don't want to suggest that I'm an expert in Section 97 matters. It's a matter for your legal counsel to discuss with your legal counsel. I will say that there are gray areas. And so it is something that you will have to consider, and you should seek advice on that. Another way to do it would be through the operating budget, and so that's the monthly assessment fee. And the monthly assessment fee could be integrated into an energy as a service type contract, or it could be a monthly loan payment. So conceptually, they're similar, although the energy as a service contract includes both utility costs and a portion for the cost of amortizing the capital equipment that you have used in your upgrade. So the benefits of borrowing, and this slide talks to the benefits of borrowing versus energy as a service type structures, and it avoids the special assessment. We've talked about that. It avoids the depletion of the reserve fund, if indeed the reserve fund would be used. Typically, a reserve fund is allocated via cash flow to major repairs and replacements over the next 40 years. So it would typically not include any sort of a provision for upgrades for energy efficiency. So it's typically not applicable. And the borrowing can be justified through saving in many instances. So I'll just talk a little bit about the loan process. Once the board has determined that they'd be interested in a loan, they would request a loan proposal from a variety of lenders, of which we would be one. We would provide a letter of intent or a discussion paper that would identify the need. It would talk about pricing and term and amortization and those matters. It would be presented to the board of directors, and the board of directors can make that decision. However, as Josh mentioned, there has to be a bylaw passed. So in Ontario, it's 50% plus one. A majority of all owners have to vote in favor. Once that's done, the loan proposal would be signed back to the lender. The lender would go through a credit approval process, relatively straightforward process, where the borrower would be required to be in substantial compliance with the Condominium Act, which means mostly there's a duly elected a board that is in place. Failing that, there is an administrator appointed by the court in rare cases. One of the most important things that the lender is going to look at is to be comfortable that there is a due process in place for the collection of arrears. So because there is no mortgage taken by these lenders, instead what they do is they rely on a general security agreement, which would provide for an assignment of assessment rights. Then the lender wants to be comfortable that the governance of the condo is following due process of law in collection of arrears. And because those assessments, those lien rights, would take a super priority over mortgages. So it's a very powerful tool that the condo corporation has to collect monthly fees, but only if they follow due process. The other thing that the borrowers are going to look for is that reserve fund study has been conducted each 3 years, and there's a funding plan that's in place that discusses how that reserve fund is going to look after major repairs and replacements, and it's going to have to provide financial reporting. The other thing that a borrower is going to look at, that a lender is going to look at, is they want to ensure a reasonable loan to value for their loan. And so the loan would be the loan amount. The value would be the aggregate value of all units in the condominium corporation. It's rarely an issue. The loan to value of these loans is typically very low, but in some cases, they can create red flags. As far as once the loan's been approved by the lender, it would go off for legal implementation. It's important that for the lender that the loans are duly authorized and executed. And so the lender will be looking for an opinion from the borrower solicitor to confirm that. And that's a due process, that legal implementation. It says 1 to 2 weeks here. It's as long as the legal team requires. Once that's in place, the documents are in place, and either the amount would be advanced and there would be a fixed term loan would commence, or in the case of a project, often there'd be a construction loan period where the lender would advance on a percentage of completion basis towards the completion of the work. And then once that work is completed, the fixed term loan would commence. During the construction period, the interest rate is typically based on prime, so it would float off prime. And once the project is completed and the fixed term loan commences, then it would be a fixed rate for the term, which could be 5 to 10 years. And the amortization period could be what the borrower is looking for, but in no cases longer than the life of the underlying asset. So often between 5 and 25 years, on the lower end of that scale, typically for energy retrofits.